In this video, I'm going to cover a highly requested topic, and that is market structure. Now, this is the most frequent comment that I receive on my videos. Can you please make a video specifically about market structure? Well, the truth is, in every single video I make, I include market structure. That's the main part of this strategy. So you guys really need to pay closer attention to the videos that I produce, because literally every single trade example starts with market structure. But I'm going to try and break it down in this video in a simplified manner that everybody can understand. So to do that, we're going to take a look at EURUSD to start off. Now, I'm currently on the 4-hour time frame. And with that being said, I want to start by saying the higher time frame that you're on, the easier it's going to be to understand market structure. On the 4-hour time frame, the highs and lows that are printed on the chart are going to be a lot easier to interpret compared to the highs and lows on a 5-minute time frame. This is simply because on a higher time frame, such as the 4-hour or the daily, you are simply seeing more consolidated data. When you're on a 5-minute or a 1-minute time frame, you're going to see much more zoomed in data. So there's a lot more, I would say, insignificant highs and lows that shouldn't really be paid attention to, but they can definitely trick you into going in the wrong direction when you're focused on those smaller time frames. Now, before I get into the structure on the chart that you're seeing in front of you, I want to mention that the little black arrows on my chart are indicating the major highs and lows within price. And this is one of the built-in features of the Currency Pros indicator, which is exclusive for our members only. But you can get a free version of this on TradingView if you just type in fractals indicator. And basically what that'll do is show you the main pivot points in price. And you can, of course, adjust the sensitivity of these indicators, and it'll either show you the most extreme highs and lows, or it'll show you those combined with all the intermediate highs and lows as well. Now, typically, I prefer to just focus on the extremes in price. So I like to focus on the extreme highs and lows. For example, this swing low here and this swing high here. Those are major highs and lows because they're the extreme of this bullish range. So I wouldn't be considering something like this or something like this. Those types of structure points don't matter to me. I'm more focused on the overall range. Okay. So using EURUSD as an example, I'm going to highlight some of the bullish ranges here so we can focus on what's really important. So there's two main bullish ranges there, and then a third one that was created just recently right here. So those are the main ranges in this bullish trend that we're currently experiencing on EURUSD. Anything that happens in between those moves is fairly insignificant. And whenever a new range is created here, we're seeing a clear break of structure from the last range, right? There's a break of structure there and a very clear break of structure here. So that's when a new range is being created. And at the current price, we can see that that's about to happen once more. It's still a little bit early to tell, but as of now, that high has been violated on EURUSD. What would make it a clear break of structure to the upside is if we have candle body closure above it. So honestly, this is the main way that I look at price charts. I look at the ranges and the current direction of trend. Now, let me clear all the drawing tools, and I want to draw your attention to all the intermediate highs and lows in between those ranges. Now, those, to me, I don't pay much attention to because, again, I'm focused on the actual range. So using this first range, for example, the bullish range from this low down here to this high, that was a clear impulsive move to the upside that violated all the previous structure back here. So all I'm focused on now is this new bullish range. And the way my strategy works is that once a range like that is created, I'm anticipating a retracement to the downside so I can enter somewhere within discount and then ride that trend to the upside. Now, with that being said, on this bullish range specifically, I wouldn't have gotten a retracement there because I like to use pretty deep retracements using the Fibonacci tool, and I typically enter at the 71%. So as you can see, price didn't make it down to the 71%. Instead, it kind of bottomed out here and then pushed higher. But here's the thing, and this is where most people get confused. As price pushed higher and broke through this high right here, that creates a break of structure, and we now have a new range to consider. So let's delete that first range and then focus on this one here. Now, this part is a bit subjective. You could draw it all the way down here as your bullish range, and technically that would be valid, but I like to draw it from where the impulsive move happened, and that would be from this low all the way to this high. Now, just to clarify, this new bullish range that was created here broke through previous market structure. It broke through that massive swing high that was printed before in the initial range. So this is now a break of structure, and that means I can now pretty much disregard everything that happened prior to this, okay? Because we're in a new bullish range now. So what do I do there? I drag the Fibonacci tool from the low to the high, and I look for a retracement entry. Now this one actually hit the 71% very nicely. As you can see, I'll just place the parameters here. stop loss at the low, take profit at the high, and let me just move that over. And you can see that it got triggered beautifully and hit the intended target. It actually went way beyond that intended target. But this is basically how I look at market structure. And now let's clear all the drawing tools again. After that impulsive move here happened, we broke through the previous market structure right here. So this was the swing high. This was the swing low. Price retraced, made a higher low, and then pushed through the previous high right here. So that's now creating a new range to trade from. So I'm going to use the rectangle tool again and drag it from this swing low all the way to the extreme high that was just created, which was up here. Now let's delete this rectangle box for a second. And I want to explain what would have happened if price didn't push to the upside and it actually continued melting to the downside and violated this low. Well, that would have been a break of structure to the downside. Now, when a break of structure to the downside occurs in a bullish trend, that is signaling a potential reversal. So if that happened, let me just draw it out for you. If we saw a push to the downside, then we'd be looking at this as a bearish range. I'll use the replay tool for a second so we can really focus on this. If that happened instead, if price continued pushing to the downside, this would be a new bearish range that I'd be considering because there would have been a break of structure that occurred right here. Of course, the first break of structure is a little bit risky because it could be simply a liquidity grab. It's always safer to enter a continuation trade once at least 2 breaks of structure have occurred, and you'd be looking at something like this. So you'd see a retracement back to the upside, a new break of structure again, and then a new retracement. So there'd be a break of structure here, and you would enter upon that retracement. And if your order gets triggered in, you'd be, of course, anticipating price to continue to the downside once more, and you'd be taking advantage of that newly created bearish trend. So that's just an example of what would happen if that structural low here failed. But let's remove the drawing tools and take off replay mode. And of course, you can see that instead of breaking that low, price printed a higher low. And a higher low means it's just simply higher than this one here. So this low held strong, and when price was retracing, it did not have enough strength to actually surpass that low and create a new low. Instead, it pushed higher, breaking through this high. So we're clearly still in a bullish market here. Now let's take a look at current price right up here. And I want to explain another scenario where a lot of people get confused because it's happening right now. As I previously explained, the current range is from these swing points here, this extreme swing low, all the way to this extreme swing high. However, if you look to the right, you can see that this big bullish candle is currently violating that structure. This could mean that price is about to create a new range. So let's draw that out and see what that would look like. If price continues higher, this would be a clear break of structure. And that would mean that we can disregard everything that happened prior to that, because we'd now be looking at a new bullish range, which would look something like this. Now let's delete the previous box. And if this new range is successfully created, I would be looking for a retracement back to the downside and then a continuation to go long once again. I would use my Fibonacci tool to map out where the retracement would ideally be. I would set a limit order there and hope that it happens. Now, of course, that doesn't always work out. As you can see down here, price was retracing, but it didn't quite get to my ideal entry point on the Fibonacci tool. That's just part of trading. You're not going to get every single opportunity. Sometimes you catch them, sometimes price leaves without you, like it did here. But if you follow this simple method of just focusing on the newly created range, you will get involved in trades. So for example, we had a missed opportunity on this range because price didn't retrace far enough into discount. This range here, however, was easily tradable. That was a very successful example of how to use this strategy. And then the newly created range here seems like another missed opportunity because price started retracing, but didn't get deep enough into discount for a safe entry opportunity. So as you can see, there's missed opportunities, there's successful opportunities, but the key point here is to not overthink structure. Just focus on the current range. So if price is bullish, like it of course is here on EURUSD, simply focus on the big impulsive bullish moves. Disregard everything in between. Just focus on those impulsive moves. I'll highlight them once again to really drill down this point. There was an impulsive move there. There was an impulsive move here. There was another impulsive move here. And it looks like there's about to be another one probably next week. So if you simply focus on these ranges, mapping out market structure will be a lot easier for you because you'll just know the high and the low of the range that you're currently looking at is what you need to actually focus on. So I hope this cleared things up. And there's another example I want to go over. So we're going to head over to USD Swiss franc and take a look at that. All right. So we're now taking a look at USD Swiss franc on the 4-hour time frame, of course. And this is another great example of market structure and the strategy that I utilize, which is a swing trading style that is very simple and effective. So this here should be clear as day, bearish market structure. If we look to the left here to where the top of this bearish trend started, you can see that it's ebbing and flowing very consistently throughout the past couple of months. You can see a consistent flow of lower lows and lower highs. Now, I'm going to go ahead and highlight the major ones here, and you can see that there is some arrows being printed in between. But again, it's simple to just focus on the current range and disregard all the little highs and lows in between. So my main advice for mapping market structure is to just simply focus on the extremes. And what the extremes mean is the highest and lowest possible points. So just take note of how I mapped out those highlighter marks, okay? You can see that the fractals indicator on my chart is showing a lot more minor highs and lows in between those ranges, but I'm just simply highlighting the extreme highs and lows so that I can map out the actual trading range. I'm not focused on this one and this one. I'm just focused on the lowest and the highest possible points. And then when price breaks through that, there's a new lowest possible point, and it breaks through it again here, which creates a new extreme low. It breaks through it again here, which creates a new extreme low, and here, which eventually, after this huge bearish move, created a new extreme low down here. So let's now take a look at the current price, the current trading range that is being focused on right here. Now, this is a very large bearish range in comparison to the previous ones back here, right? All of these bearish impulsive moves, those are pretty small. However, the most recent one here was very large. Now you can see that price dropped very rapidly to the downside, so there's not really a bunch of highs and lows in between like you would normally see. So this one's a lot more easy to understand. It's just one straight move to the downside. So there's obviously a high up here and a low down here. You shouldn't need an indicator to tell you that. So here's where a lot of people get confused as well. The retracement back to the upside contains a lot of minor highs and lows, as you can see here. This is where people start to get thrown off. Should I be buying? Should I be selling? What should I be doing? Well, within all of this minor bullish price action as price was retracing to the upside, you have to ask yourself, is the initial range that I'm focusing on still valid? And what I mean by that is, if this is the swing high and this is the swing low, have either of those points been tested? Have either of those points been violated? Well, no, absolutely not. So that means all of these minor structural points in between are insignificant. Now, if you want to go down to a lower time frame and day trade within this price action, that's perfectly fine. That's not a topic I'm going to discuss in this video, but that's when those minor structure points come into play. Now, if you're focused on one time frame, such as the 4-hour or the daily, and you're trying to swing trade like I do, then you need to just be focused on the overall swing points of the range. Anything in between should not be of your concern. So this is a pretty textbook example of the swing style strategy that I implement and how I focus on market structure. As you can see, my Fibonacci retracement was drawn again from this swing high down to this swing low. You can patiently wait for price to retrace back to your ideal entry point, which in this case is the 71. And you can see how price just absolutely sniped that 71 and then started pushing to the downside. And this is a perfect example of why all of this price action should be ignored. It is irrelevant because as soon as price got into premium areas of this bearish range, we can see how strong this reaction was and how much it's pushing to the downside. And it's significantly pushing right now, and it looks like it's going to take out this low after all. Now, let's do a little exercise here and map out potential future price so you can understand this even further. So if this current bearish move continues significantly to the downside, let me actually hide this Fibonacci tool. If price pushes like this to the downside, then that means, of course, this low will be violated, which is a break of structure. If that's the case, that means we're going to have a new bearish range from this swing high all the way down to wherever the extreme low is printed, okay? Let me hide this position as well so we can focus. So we'll have a new bearish range. And at that point, you can drag the fib tool from the swing high, the extreme swing high, that means the very top of this range, all the way down to the extreme swing low, which is wherever the range bottoms out. Now again, once that is locked in place, we would anticipate price to retrace again, just like it did right here. We'd be looking for our retracement entry, and then ideally price would move in that direction once again, and we would capitalize on a continuation to the downside once again. Now, let's take a step back here. If this move just keeps going up and violates this swing high, That means our bearish trend is no longer valid and we should be now focused on bullish market structure. So that is when we would be paying attention to these lows and the highs that are being created, and we would look for retracements and continuations long. In this video, I intentionally did not want to complicate things, and that's honestly how I do it in my own trading as well, because market structure is one of the most overcomplicated and over-talked about things. And honestly, it is so simple. You literally just focus on the extreme highs and lows. What I'm going to do for you is actually open up the Currency Pros indicator. This should be a setting in most fractal indicators. Let me just pull it over here. I currently have my sensitivity set to medium. Now, if I set my sensitivity to low, pay close attention to the arrows on my chart. When I set it to low, some of those arrows disappear. If I set it to high, there will be much more arrows printing on the chart. Just focus on this region here for now. You can see that there's a ton of arrows there. It's going to focus on all the intermediate highs and lows. This can be very helpful for day trading. But if I turn it to low sensitivity, a lot of those arrows will disappear. In some cases, it'll be even less than this. It really depends. But if you're using a free fractals indicator on TradingView, which there are plenty, you can adjust the sensitivity to whatever you'd like. And especially if you're a beginner trying to understand market structure, I would strongly suggest that you play around with your indicator settings until it shows literally only the extreme highs and lows. So that means it wouldn't be showing any of this stuff. It would only be showing the extreme points, like those ones, and these ones here. So literally the very highest and lowest points of the current trading ranges. This is easily doable. All you have to do is stop overthinking it, okay? The biggest takeaway from this video should be to focus on the macro perspective, and that means the bigger picture. You don't want to focus on the micro, because that's when traders get chopped up and thrashed around and lose all their capital. If you simply focus on the bigger picture, such as this high to this low, then it'll be a lot easier for you to trade, because anything that happens in between, you'll know is insignificant. Just focus on the extreme prices of the current trading range within the current trend. And until this high or this low has been violated, literally nothing has changed. So I really hope this video helped clear things up in terms of market structure, but I once again want to clarify that every single video I ever post that has anything to do with technical chart analysis contains detailed talks about market structure, because it's pretty much the first step in my trading plan. So whenever I'm outlining a past trade or an existing trade or a future trade that I'm looking at, I am always discussing market structure and the criteria that has to be met in order for me to be comfortable taking that trading opportunity. I encourage you to pay closer attention and really understand the words that I'm saying in these videos, because on YouTube, I don't hold anything back. I'm not one of these internet gurus who claims to have some secret information. I share everything on YouTube because all of these concepts are already readily available on the internet for free. Now, I of course do have a mentorship program, but mentorship is much different. That's like a weekly guidance type thing. I'm guiding our members on a weekly basis through live sessions and pre-recorded content, sharing my trading ideas with them, doing case studies on past trades, answering their questions during live sessions, guiding them through trials and tribulations. These are the types of ways that I provide value. But these technical concepts that I'm discussing today have been around for decades. It's nothing new. I didn't invent them. I can't take credit for them. But what I can do is share my experience with you all and hopefully smooth the learning curve in your trading career. So I really hope you enjoyed this video. If you want to connect with me further, you can follow me on Instagram. Send me a message there if you'd like. I'll leave the links to my Instagram profiles as well as the Currency Pros Academy in the description of this video. Thank you all for watching, and I'll talk to you all in the next one.